Welcome to the 2014 June quarterly webinar. I guess when we look back over the last 12 months, probably the most surprising aspect of the year is the fact that the status quo in markets has been maintained in terms of price action, money flows. And what I mean by that is historically low government bond yields and property yields. Equity prices that continue to edge higher and seem to be ignoring any geopolitical news such as the war in Crimea, etc. The elevated currency, and that's despite the fact that export prices have now contracted by 30 to 40%, whether it's iron ore in Australia or dairy prices in New Zealand. And basically very low volatility. It appears that the monetary authorities have become markets. Now, despite that, I actually believe that the tide is in fact turning. The price action that we have witnessed over the last few years is unlikely to be repeated going forward. And the thought process is reflected in our portfolios at the moment, in that we're approximately 70% invested in both our global and Australian portfolios. We basically sold down a number of positions during the year with the belief that we would be able to redeploy that capital at some future point in time. The basic framework that we're operating on really hasn't changed. We firmly believe that the risk reward from owning a business at the moment is far superior to that of government bonds or property or cash. How far superior is tough to determine because we do have abnormally low interest rates. And if you also think about the elevated currency and our observation that domestic investors have minimal diversification offshore, it probably adds up to owning businesses offshore. If you look at the portfolios and the themes that are dominating at the moment, most of these themes are well known by our investors and we've communicated them in the past. But just to remind you, the first big theme is the evolving recovery in property prices that were decimated by the global financial crisis. We started in Las Vegas, but recently we've also made investments in Ireland and Spain. Secondly, our domestic banking franchises, and third, futures-dominated exchanges that we think are monopolistic in their sort of business characteristics, but with the low volatility, they're going through cyclically depressed trading activity, but we expect that to pick up in the future. Now, if you look at all these themes, there's no doubt that valuations have in fact recovered, but as I mentioned, they're all still operating under industry conditions that are well below normal. The US housing market has recovered, but yearly sales are still probably at least a third below normalised trends. If you look at Spain and Ireland as examples of the further recovery in property prices, Ireland took their medicine early and are further advanced in the process. But what we've seen over the last 12 months is that there's been a decent recovery in office rentals and housing prices in Ireland. A lot of foreign money is coming into that market and prices are starting to be bid up. Spain is a little bit further behind in the process, but again, I suspect it bottomed late last year. And again, we're seeing a lot of foreign capital now starting to come in to arbitrage the opportunities in Spain. So as I mentioned, we did add to our positions over the last 12 months. We also own a number of consumer branded companies, Google, Heineken and Anheuser-Busch, our brewers. The reality is though, we'd like to add to that mix. We're currently doing a lot of research, trying to find potential opportunities. Price action hasn't afforded us the opportunity as of yet, but we believe if we're patient, the reality is some of these businesses are finding that they've got some headwinds in terms of near-term earnings, and we suspect that will create a bit of short-term disappointment that we'll be able to take advantage of. Other than that, all our efforts are really focused on finding new opportunities outside our existing property and financially dominated investments. And I still believe that by the end of this year, my expectation is that we'll be fully invested from our, as I mentioned previously, 70% invested positions. So that's really a quick snapshot. There's not a lot to say this quarter. As I say, the themes are pretty clear and what we're trying to achieve is pretty clear. Yeah, we do believe that the combination of a little bit more valuation re-rating, the earnings growth that we see in our opportunities over the next 3 to 4 years, we should be able to achieve the sort of 10% return, annualised return type objectives that we think is sensible, for the markets that we're in at the moment.